Okay, let's get this ball rolling. Hello and welcome to Make Your Property Work For You, brought to you by Herod Wright. So just a couple of comments just to get the ball rolling. So any questions that you intend to use, please feel free to use the Q&A section of this call. We'll aim to go through them at the end after everybody's presentation. Any that we may not get through, we will be sure to, one way or another, drop you a quick email, hopefully answering those questions. So really looking forward to it, and hope you really enjoy it. We've got three speakers. We've got Alistair to discuss the tax breaks and benefits around property, and obviously he's a fellow director at Herod Wright, or the big man, the MD, along with James from Hammock in relation to the software and how that can really work for you. And then finally, but no means least, the main event, no, not really, is Gareth from Platinum, who is going to explain why you should use a mortgage to build a property portfolio. So without further ado, like I say, please use the Q&As, get them in there, and we'll get the ball rolling with Alistair from Herod Wright.
Cheers, Gareth.
No problem.
Perfect. Thank you. Hello, everyone, and thanks for sparing the time to join us here this afternoon. I've got around 10 minutes with you initially, which is a bit of a challenge, as I can easily do several hours on this stuff. So this is going to be a little bit of a whistle-stop tour. However, I've set some time aside tomorrow to answer any queries that you don't manage to get through on the Q&A today. So feel free to drop me an email. My email address should be on the screen at the moment, and will be again at the end. More than happy to have a more detailed conversation around any of this stuff. So let me give you a little bit of background initially. My name's Alistair Herod Wright from Herod Wright Accountancy Group. I'm a chartered accountant of nearly 20 years. I know, I don't look old enough for it. I've run Herod Wright for nearly 15 years, and if I'm honest, I'm an accidental property investor, certainly initially anyway. I make the point about accidental property investor because this is the same for a lot of people. I didn't initially intend to build a multi-million-pound property portfolio. It just happened that due to a change in a relationship, I had a house that I once lived in that I no longer resided in, and so chose to rent it out rather than to sell it. I feel that these circumstances, it was likely that maybe the financial foundation of this property investment wasn't maybe as solid as it really should be. And that's kind of the basis for my presentation today. So without further ado, let's get into this. Firstly, I want to talk to you about ownership. It could be that a property is owned personally by an individual, or maybe jointly, or maybe inside a limited company, but more on that later. If the property is owned by an individual, all of the profits are taxed on that individual at their marginal rate of tax. This means that, say, someone has a salary from employment of, say, £99,000 per annum. Any rental profits that they then receive could push that total income over £100,000. £100,000 is a really important point with income tax, because at this point you start to lose an element of your personal allowance, which means that this actually results in a tax rate of 60% if you're in that band between 100 and 125,000. If, however, it's owned jointly as tenants in common, then we can alter how the profits are split between the owners. This can be really useful if, say, spouses have unequal income levels, and it may be that this would allow us to stop pushing someone into that higher rate tax band. Joint ownership also helps if the property is sold. In this situation, as any profits on sale can be split between the owners, sometimes allowing us to use 2 or more tax-free capital gains allowances. There's also a few other ownership options, which I note on the right-hand side of the slide, but that's more advanced stuff, which isn't really a topic for today. But as I say, more than happy to chat with people about that. Next, I want to talk about costs and expenses. we see so many cases where landlords are not claiming for expenses that they really should be. Now, HMRC have a default position with regards to costs and expenses across all businesses, including property businesses. And this is the phrase known as wholly and exclusively. Basically, for an expense to be able to be set off against one's income and then therefore reduce their profits for tax purposes, the expense must be for the purpose of the business. There is such a thing as mixed use. This is where an expense can be served more than one purpose, but it can be subdivided between a personal and a business need. In these cases, the business element can offset against profits, hence reducing the amount of tax payable. It's this mechanism that allows landlords to claim for motor expenses, say, when travelling on trips relating to their property business. Therefore, we should be claiming for travelling to and from our properties, maybe potentially viewing new properties that we want to purchase, and even visiting our accountant. There is, of course, the flip side, where let's say you purchase a new suit, maybe to show potential tenants around your property. This is an example of a dual purpose expense, where yes, the suit enables you to look smart, but also provides decency and warmth. Therefore, it's not allowable for tax, unfortunately. Some of the common expenses that we see property investors and landlords failing to claim for are use of home as office. Most, certainly the smaller landlords, will run their businesses from home. Therefore, a proportion of those household bills and expenses are claimable. Mileage and travel expenses, as I've mentioned in the previous example, should certainly be being claimed. And one that we really do see missed a lot is training and research costs. So if landlords attend courses to develop their knowledge in the field, that's all allowable. Next, I want to discuss repairs and maintenance costs. This is an area that's open to a lot of flexibility, since costs here need to be split between repairs and improvements. Where we have a repair cost, this can be offset against your annual rental income, whereas an improvement cost is added to the value of the property, and you only receive that tax saving when the property is sold. This is really important for two reasons. One, most people want to save their tax today, not at some point in the future when you may or may not sell the property. I think Gareth's going to talk later about you should never be selling properties. And secondly, if an improvement cost is to be used when the property is sold, then we need to make sure that we're keeping the paperwork for however long we need to keep it for up until that point of sale. And luckily, James at Hammock, that you'll hear from next, will give you an easy way of doing this. As an example, let's say you decide to change the old timber frame windows in your rental property. If you replace these windows with similarly timber framed windows, this is going to go down as a repair. If you were to change them for UPVC double glazed units, then this is also likely to be a repair, since although you may feel that this is an improvement to the property, they are likely to be cheaper than trying to source the timber framed units these days due to the technological advancement. The improvement element is therefore disregarded, and so they continue to classify as a repair cost. If, however, you decided to change these standard windows with new bay windows, this is likely to be an improvement, and hence the cost will be set off against the capital gains tax that you pay when you come to sell the property. This whole area of interpretation of revenue versus capital expenditure gives us some opportunities, and it's an area where some advice really does need to be sought. Unfortunately, I do need to come on to mortgage interest and finance costs at this point. So back in April 2017, the government introduced the horrible Section 24 mortgage interest relief cap on residential landlords. This basically means that you can only receive tax relief at 20% on interest, even if you're a higher rate taxpayer. There is still a common misconception knocking around that there is no tax relief on mortgage interest, so that is not correct. There is still tax relief, but it's by way of a tax credit rather than just setting the mortgage interest off against your rental income. It's important to understand that this has other implications. Not only is the rate of relief being restricted to 20%, but the calculation has also changed, which means that your overall income, including rental income before that mortgage interest has been taken off, is your total income for the year. And this means that we're seeing some landlords that are being tripped over into a higher rate tax band because the rental income is before mortgage interest is for their income level. If this also can push somebody over the £50,000 a year income level, we're seeing a problem where landlords are having to repay child benefit that have been previously claimed because of the rules around repayment of child benefit. As I say, this really is a horrible piece of legislation, which the industry feels undermines some fundamental tax principles. It does, however, only apply to residential properties that are owned by individuals, which I'll come back to shortly. Just want to quickly touch on another tax while we're here, stamp duty land tax. When you purchase a property, normally the stamp duty is dealt with by your conveyancing solicitor. This is an area that can be quite specialised, and not all solicitors, unfortunately, are fully up to speed on the options. Absolutely no disrespect to solicitors at all. The legislation can be a complete minefield. As an example, last year we reduced a client's stamp duty tax bill on a £850,000 property purchase from £58,000 to zero. This was just using a combination of different reliefs, and it just highlights the point that every case needs to be assessed on its own merits. So I do tend to advise people and suggest to people that if you're buying anything other than a fairly basic bog standard residential property, that maybe some specialist advice should be taken. Making tax digital is a bit of a buzzword within our industry at the moment. If you haven't heard about this yet, you certainly will over the coming year. This is the government's push to make all businesses keep electronic records. Self-employed businesses and landlords with incomes greater than £10,000 per annum will come under MTD from the 1st of April 2023. Again, luckily, Hammock can help us do the heavy lifting on this stuff. Finally, I just want to jump back to ownership. As I mentioned, limited company ownership. This is an area that we saw an explosion in when the mortgage interest rules changed back in 2017. It's not a method that works for everyone. As a general rule, it works for higher rate taxpayers who are looking to grow portfolios of property. This is the structure that I use personally at the moment. As with everything, there are pros and cons. Tax rates are cheaper. As I say, tax rates are cheaper within a limited company. So it tends to work if we're retaining our profits from our rental income within the limited company, because as soon as we start to try and take any of that money back out of the limited company, it can get more expensive. One of the big pros of the limited company is that it doesn't fall under the mortgage interest cap. So you do get full tax relief on your mortgage interest. On the screen now, I've just dropped on a couple of tables to give you a very high level overview of some potential savings. On the left, we've got a selection of rental income levels and showing the tax saving that can potentially be made through a limited company. These do take account for potentially having to pay slightly higher mortgage interest rates because the mortgages available within a limited company generally are slightly more expensive. But even taking that into account, you can see the potential savings. On the right-hand side is a table where we leave the profits within the limited company and grow our portfolio. And as you can see, there's quite significant savings. Again, every case is different. So I'm just keen to give you the flavour of the possibilities. I'd encourage you to talk to your advisors and explore what options best fit for you. that's everything I want to cover with you today. I'm very conscious that there's an awful lot of information at a very high level, and really it's just to give you a flavour and give you something to think about. Talk to advisors, take advice. As I say, I'm set some time aside tomorrow, so please do drop me an email, and I'm more than happy to have a more detailed conversation. I've also got a little bit of documentation, some summary stuff that we give out to clients, and that'll be out on an email to you over the next couple of days as well. So on that note, I'll pass over to James from Hammock. We've been working with Hammock for some time now. It's a lovely piece of software. I use it personally, and I think it's got great opportunities.
Perfect. Thank you very much, Alistair. Yeah, so my name's James, and I'm in the business development team here at Hammock. I guess, it's going to be a fairly quick demo here because, I've only got a small section, but hopefully it'll give you a good flavor. One key thing, I guess, to mention is that, before we were ever working with accountants, we built this for landlords. So I'm a landlord, my CEO's a landlord, our head of tech's a landlord. We built this for us and the problems that we faced. And so, first and foremost, this is a product for you. It just so happens that it does also give your accountant everything that they need as well. So I'm just going to take you through it. That you probably will have some questions as I go through this. So, as Gareth said at the start, just pop them in the Q&A and we'll kind of deal with them at the end. But, you've got the menu on the left-hand side here, which kind of helps you navigate Hammock. I'm starting on the properties page because I think it's a really nice place to start. The first thing you would do is you will add your properties. And as you can see here, we immediately pull an image from Google Street View. So you can sort of see your property. For each one, you can see, how much money you're making. You can see, your income, your expenses, your profit. If your tenants do owe you any money and they're in arrears, we'll highlight that for you here as well. What's also important, just quickly to mention here, is I also have 3 portfolios. This ties in quite nicely to what Alistair was talking about, the different ownership structures. So in this example here, I've got one property here, which I co-own with my wife. The next 2 I own all 100% own myself in my personal name. So I've got those in a different portfolio. And this bottom one is in my limited company. So you can, regardless of your structure, you can add all your properties into Hammock. And then when we get to the tax statement area, that's kind of where it gets split out for your accountant. So just going to quickly show you kind of where these figures come from. And for that, we jump over to the transaction page. Now, hopefully some of you are familiar with the term open banking. What open banking essentially means is that you can connect your existing bank accounts up to Hammock, and basically it then gives you a digital bank statement effectively within Hammock, and every day we pull in new transactions. You've also got these filters here so you can help navigate your transactions. And if I scroll down, you can see anything that's kind of already got a green category that has already been tracked and categorized. Anything that says click to track is still kind of waiting to be done. So I can literally just click on that transaction. Because this is an expense, the menu opens up on the right-hand side with all the different expense categories. Again, going back to what Alistair's saying about the different ways you need to categorize expenses. For example, if this was a capital expenditure, you might come into money here and select capex. Equally, if it's just a regular piece of maintenance, you might come in here. Mark this as general maintenance, maybe it's a gas certificate, etc. Have all our categories are all tailored towards landlords. So for example, if that was a gas certificate, I can then select which property it relates to, hit save, and you can see it's now tracked as a gas certificate for 23 New Church Road. If that did happen to be a regular expense like a mortgage or insurance or even rental income, that will now start tracking automatically. So next month or next quarter, next year, I would just get a notification letting me know that has tracked automatically. It works exactly the same with rental income. So actually what I'm going to do, I'm going to search for a keyword of TSB, because I know that my tenant puts that at the start of their reference. And now I can only see transactions that contain those letters TSB. You can see these rent payments go back to the start of this tenancy in March 21. So I can just click on any of these. This time I get the income categories. So I'm going to select rental income. Again, select my property. I've already added the tenant, so that just gets auto-selected, and I hit save. Just as before, and you can see here, that's now been assigned rental income against 23 New Church Road, and against the tenant, Tom Dawson. But obviously, I want to track all of these other payments as well, and I don't want to have to go through them one by one. So all I do is I've got these two different options here. I've got view matching transactions and search and track. Because I've already filtered, I'm actually just going to use this first one. So I click search and track. All of these transactions now, you'll notice, have this little box, like a tick box. But actually, because they're all rent, I'm just going to hit select all, update 10 transactions. And just like that, I've just tracked my entire tenancy. And I say going forward, it will now, next month, it will just track automatically. And in fact, if my tenant hasn't paid by the next due date, I'll actually get a notification that my rent is late, so that I can start chasing it as well. Now, that's kind of how you do your bookkeeping on your end. From there, Hammock basically takes that information and gives you a load of insights. And one of the key ones is actually, as well as giving you your P&L by property, we also give you your rental history per tenant. So for example, if I click on Robert Green here, you can see here that Robert lives at 11 Newcastle Road. He pays £14.50 every month, starting in March. And just based on that information alone, Hammock creates this rent table. So you can see starting back in March, and for every period, it tells you how many transactions there were, how much was due, how much was actually received, and what's your outstanding balance. So you can see here in May, they actually missed a payment, fell into arrears. Then from June onwards, they started paying the rent again. And actually from September, they've started overpaying to start paying off some of that balance. And actually, if you look here, you can see these all have 2 transactions. If I just click down here, you can see that they paid the £14.50 on the 19th, but they're also paying this additional 100. And that is why the balance is dropping. But Hammock, does all of that automatically, so you know exactly where you stand. Equally, if any of you use a letting agent, when you set up the tenancy, you just tell the system that you use an agent what your fees are. And even though it's the net rent that hits your bank account, Hammock will actually gross that up to the full rent, and it will create the letting agent fee for you automatically. So we can have, Hammock works for you, whether you have 1 property or 30 properties, or if you manage it all yourself, or if you use an agent and it's kind of just on the side. Either way, you can use Hammock for what you need. Obviously, all of that data then also goes into your tax statement. And so this is actually the first place where you're going to see these 3 portfolios that I mentioned at the start. So I've got my personal properties here, my joint and my limited company. So if I go into my personal properties, for example, you can see here at the top, James owns 100% of this portfolio, and I've got 2 properties in here. I can then filter this by tax year. I can even filter by property if I want to drill down a bit further. I've then got my basic figures at the top. Then the key parts that Hayward Wright are kind of keen on here is these totals, because these are the different amounts they're going to have to report to HMRC each year as part of your tax return. And say moving forward, Alistair mentioned MTD, making tax digital. It also means they're going to have to start doing this quarterly rather than annually. So having access where you both have access to these same figures and you can both make changes in real time is going to make both of your lives much easier. And then underneath, obviously, you've got all the transactions that have been tracked to this portfolio. And you can even sense check this. If you're wondering, how did I spend £620 on property repairs and maintenance? You can just click on it, and this will update and then only show you those transactions as well. Just one final thing I'm going to show you on the tax statement is this joint ownership piece. So if you do have joint ownership properties, maybe you own them 50-50. It may be that you own them not 50-50. In this case, I own this with my wife. I've got 25%. My wife's got 75%. So if to Alistair's point about moving into different tax brackets, if you do get set up, if they do advise you to set it up where one of you owns more, you just put that into the portfolio details and Hammock does the sums for you. So you can see here, it's got all the same information, but in these boxes, as well as kind of giving you the 100% figure, it actually highlights the 20% that's the figure that's for me. But equally, if my wife Penny wants her figures, you just click over here and it updates and shows you her 75%. So that's kind of, all the bookkeeping and tax. There's just a couple of final things I want to show you just before I wrap up. As I said at the start, we We built this for landlords first, so there's quite a lot of in here that's just for the landlord. If I jump to the overview screen, you can sort of see here your P&L throughout the year. Hammock can give you property valuations and then track your loan to value across your portfolio. You can see your occupancy rates, upcoming payments. You can compare your rental yields across your properties, and you can obviously see here what arrears you've got. By the way, all of this is also, not only is it available free to Hayward Wright clients, you also get the mobile app. So all of this is also on an app, as well as web cloud software. And then just the final thing, just because whenever we ask landlords what they like about Hammock, this always comes up. So you can also store all of your important documents here. So, things like your gas certificate, your insurance, your fire alarm certificate. Not only do you then have everything in one place, linked to the correct property or tenant, but because you set an expiry date, Hammock then starts sending you reminders. So you can actually see these two actually expiring fairly soon. So I'm going to start getting reminders on these two. But you can also filter and go, right, what do I have to worry about in the next month? Okay, I need to renew my insurance, renew my gas cert, etc. So loads of stuff in here, which is really going to make your life easier, your accountant's life easier. As part of the deal that Hayward Wright have purchased, anyone who signs up also gets a free onboarding session with our team. So all you need to do is register. One of our team will contact you, book you in for a one-on-one Zoom session at a time of your choice, and we'll actually help you get set up. And if you do only have, kind of one or two properties, it really can be done in, half an hour or even an hour. So really simple. And then a lot of the automation takes in after that. So yeah, if anyone does have any questions, pop them in the Q&A and we'll cover them at the end. But yeah, I think I'm at the end of my time. So I'm actually now going to pass over to Gareth, who's just going to give you a bit of a session about the importance of buy-to-let mortgages.
Hi, everybody. Thank you, James, for the great intro and the exciting software. I'm Gareth Evans. I'm in a bit unique as a mortgage broker because I actually own a lettings business and an estate agent. So it gives us an interesting insight, and previously an IFA. So my perspective is a bit different to the average broker or the average letting agent. So what I want to focus on today is why you should be using a mortgage for investment reasons with your portfolio rather than buying with cash and so on. So a buy-to-let mortgage is not just for a purchase; it actually is an important tool. So I'm going to crack straight on. First of all, it's useful for using other people's money. We'll talk about how you can gear your growth, why you should never sell your property, and how a mortgage can help with that. How passing it on for inheritance tax, and how you can use company cash if you're like me and you run a limited company and you're cash rich, how you can use that in your portfolio as well. And then a quick round off, because we might as well cover some mortgage information about how to obtain a buy-to-let mortgage. First of all, other people's money. Let me just move that mouse out of the way there. Let's say, for example, you bought a property for £200,000 for cash. The good news is that you'll then be able to keep 100% of the rent after expenses. So that sounds attractive, and some people like that. And let's assume that you get 5% rental yield on that property. This is just to keep the maths easy, and these are broad brush concepts. So that means that you'll get £10,000 a year off that property. However, if you use your £200,000 as a 25% deposit and you buy 4 houses using mortgages, otherwise other people's money, that means you'll get £40,000 a year because you've got 4 times the money. Of course, you're paying mortgages, but mortgages are at 2.5% for a pretty ordinary buy-to-let mortgage, roughly 2.5%. So that means on 4 £150,000 mortgages, 75% of the 200. That means that the total cost per year is £15,000. So on each mortgage. So after the mortgage, £40,000 minus 15 means you'll get £25,000 per year. So not only have you got 2.5 times the yield from that, he says, I've just done the wrong way. Essentially what I'm saying is, if you can buy a property with a 5% yield and use other people's money costing 2.5%, then you'll just basically you'll make more profit. So other people's money is one reason. The other reason is gearing. What do I mean by that? First, we've got a £200,000 property. Now, lots of people talk about property growth, isn't it fantastic? It grows and grows and grows. However, I want to focus on just inflation, because actually I believe because we've had a period of the lowest interest rates, for quite a while now, the properties are going to grow by about 3%, or either in line with inflation or earnings. So if you base it on that, then in 25 years' time, your property would have doubled in value. Sorry, my slides are going on their own here. So it would double. So therefore, you make £200,000 worth of capital gain. However, if you bought 4 properties, £200,000, then actually you've got a £1.6 million worth of property at the end of it, which means that after deducting the mortgages, you'd have £1 million in growth. That's essentially because you've just made 4 times the overall capital investment for the property in inflation. Sorry, our slides are going on their own here, which I don't know how to stop it. Let's try that. So essentially you've geared up your investment. You've geared up your investment so that you have more property invested, but you've got the same cash. So as a result, that's why you've got a higher growth level. So next one, never sell. Now, if you had a property of £200,000 and it did double, and let's ignoring mortgages for a moment, then that'd be worth £400,000 in 25 years' time. If you sold that property, assuming leaving capital gains allowances and details to one side for a moment, then the tax would be £56,000. That's 28% on the gain, because you've gained £200,000, and 28% is what you get for a higher rate taxpayer. So actually, your proceeds would be £344,000. So let's say if you had your portfolio, if you got to the age of 75, thought I've had enough of it, and that's what you've got to show for it. However, what you could do is remortgage, and yes, you can remortgage at the age of 75. So on your on your £400,000 property, we could remortgage, pull out 75% of the value, no tax, because you haven't sold. You haven't sold and you haven't disposed of the property. So you've now got £300,000 in your pocket to go and enjoy yourself, but you've still got £100,000 invested in equity in the property, of which you could still sell at any stage going forward. Obviously, you'd incur the capital gains then, but you could also pass it on to your children, which is what. So I've got a few technical issues here, which is just what I'm going to show you now. So, passing it on. If you bought a property for £200,000 and it's now worth 400, and you left it in your will, then that would be £400,000. 40%. That's £400,000 in value, and that's 40% in capital in inheritance tax that you would pay. Again, I'm leaving out the allowances and information like that, but clearly that's a significant sum. That's £160,000 that you're giving to HMRC. However, what if you decided a few years earlier to remortgage that property, take £300,000 out, and use that money and gift it to your children to help them on their property ladder, and perhaps a family home that they want to buy for themselves, or investment properties of their own? Then your estate, when you come to your £400,000 figure, is actually only worth the equity in the property, which is £100,000. So therefore, you're being taxed. The £100,000 equity will be taxed at 40%, which means you're only paying £40,000 because you freed yourself up to gift that money up early. So don't sell and pass it on, but keep a mortgage on it. Investing in a company. Perhaps you've got a company and you've got cash in your business bank account. You're a successful business. You've got a couple of £100,000 sat in the business current account, and you want to exploit that cash because it's just sat there doing nothing. What we can do is buy a special purpose vehicle, a limited company like Alistair was talking about, just for the purpose of buying property, holding them and letting them out, what you can do is use an intercompany loan, extract the £200,000 out of your trading business and use that as your deposit within the other limited company. Because that's a loan, there's no tax. So that can start you off and get you using that company money for your buy-to-let mortgages. A good way of starting off and building your portfolio. So who can have a buy-to-let mortgage? First of all, you need a 25% deposit. You've got to be between 18 and 80 currently, although no income is required, but some lenders do say they want £25,000 worth of earnings, but they're the mainstream lenders. They're the mainstream lenders rather than specialist lenders. Plenty of specialist lenders say no income. You could be a first-time buyer. You could be a first-time landlord. You can actually find a rundown property and do renovations and to let it out afterwards. And you can even you can have your properties could be from that your target market is for properties for flats, to families, to students, to even letting out to companies doing residential living, for example, supported living. So that is my whistle-stop tour about why you should have a mortgage on your property to gear up your investment, to avoid capital gains when you come to retirement, to make it easier to pass the property laws and inheritance tax, and to let you know that there's plenty of different options for mortgages out there that will suit you and help you on your way. So take advice, because I've just done some broad brush approaches now. They're just examples. Do your research, speak to an accountant, speak to your letting agent to find out about the opportunities in your area, speak to a mortgage broker to find out what mortgages will suit you. And in my view, property is the perfect investment. Thank you very much. Apologies for a few technical errors, but I'm Gareth Evans, and you may contact me afterwards if required. Thanks.
Brilliant. Cheers for that, Gareth. And thank you also to Alistair and James for those presentations. I suppose that time and effort now is coming to the old and any questions. Thank you ever so much, everybody, for sending across the questions within the Q&A tab. Really appreciate that. And hopefully we'll just go through a few of these, because obviously we do want to try to clear this up by Q2. So we've got 7 minutes, so I'm sure we'll be able to answer a couple of these. So the first question then comes from Daniel and Thomas Casper. Hi, is it possible to own a property as a foreign individual? Alistair, are you happy to handle this one?
Yes is essentially my answer. I don't see an issue with that. I don't know whether Gareth you want to touch on.
Mortgages are available as well for foreign individuals. Circumstances is important, but the answer is yes, and there are specialists in the market. There's even offshore banks that will lend into the UK.
Brilliant. Perfect. Another question as well then from Stacey Main. Hi, how can I move my portfolio from being personally owned to a limited company without being hit with CGT? I'm pretty sure I know the answer to this one, but Alistair?
It is possible, potentially possible, but there's an awful lot of ifs, buts and maybes in there. As I say, Stacey, if you want to reach out, if you want to drop me an email, I'm more than happy to. No cost, no obligation, more than happy to have an initial conversation. But we need to go into a lot more detail than we can in this forum, but potentially yes.
Perfect. Cheers that way. So switching it around a bit then, I suppose David Irwin's asked, how much does Hammock charge?
Yeah, so if you were to come to us directly, our pricing is based purely on the number of properties. So if it's 1 to 3 properties, then it's £5 a month plus VAT. If you have 4 to 10 properties, it's a £10 a month plus VAT, and more than 10, it's £20 a month plus VAT. Now, of course, if you're a Hayward White client, they're supplying this software for free. So yeah, I don't know if David's a client or not, but potentially free.
Sign him up. Brilliant. Cheers for that. So anonymous attendee quick one on hammock as well. How does it work with HMO tenancies? And I suppose, can it, is the question.
Yeah, it can. In fact, I might just quickly share my screen if you don't mind.
Yeah, while you're sharing your screen there, James, I can vouch for this. This is one of the selling points for me when I spoke to Hammock. I've spoken to a couple of other people that do different, similar products, slightly different, and HMOs were always a problem. I have actually got HMOs that I'm managing on Hammock, and it works brilliantly.
So I just add this property here, and I just say yes, it's an HMO. And so it's 4 rooms. Add the property. And then if you scroll down, you'll see that as opposed to the other ones that just have a green dot, this one now says 0 out of 4. So every time you add a tenant, it will go 1, 2, 3, 4 out of 4. You'd still get all the rental history per tenant in the same way, but you can put all your costs through this one property. And to go back to what I was saying before about how we charge per property, this still counts as one property, even though it's got 4 tenants. So it's actually really, really cost effective if you're an HMO landlord.
Brilliant. And I think we might be able to get a couple more possibly. So David Owens also asked, why is there so fewer mortgage options for Scotland and Northern Ireland when compared to Wales and England?
Yeah, if I can pick that one up, Gareth. We've actually managed and I've done mortgages up in Scotland, and one of the issues that you have in Scotland is that their rental rules or letting rules are completely different. One of the things they've done is remove section 21, which means that to evict a tenant, you've got to have grounds. Wales is talking about doing that. England is a little bit further down, is also looking at 3-year tenancy agreements and so on. I think once they're aligned, then the England-based lenders will start to appreciate Scotland. Scotland and Northern Ireland. I'm not familiar with Northern Ireland, so perhaps I shouldn't. But so much of that. But I think once the lenders start to understand it, we saw this with HMO licensing. Certainly, Coventry Building Society, for example, wasn't stopped on and ending in Scotland at one stage because of licensing, because they just didn't understand it. Now it's prevailing pretty well everywhere. With additional licensing I'm referring to then Coventry certainly decided that perhaps they'll play the game. I think that's really my the reason why.
Brilliant. Okay, no, thanks ever so much for your time, guys. Really appreciate that, and thank you for joining us on this webinar. Really appreciate your time coming through and spending it with us. Hopefully some of these questions have cleared up quite a few of your concerns and various bits and pieces. If not, please feel free to drop any one of the team that have been on the call an email, and we'll be sure to get back to it one way or another. So thanks very much for your time. We're slightly bit ahead of schedule, which is great news, so you can easily get home, maybe even beat the rush time traffic, but who knows. So that's everybody from here, from Herod Platinum and Hammock, wishing you a great evening. Thank you very much.
Thanks everyone.
Take care.